Section 1.1 to 2.3 Fundamentals of Stop-Loss Orders. Stop-loss order, managing risk and preserving capital through stop-loss orders. 1.1 Definition and purpose. A stop-loss order is a type of order placed with a broker or exchange to automatically sell or buy a security, such as stocks, commodities, or cryptocurrencies, when it reaches a specified price level. The purpose of a stop-loss order is to limit an investor's potential loss on an investment and to manage risk. When placing a stop-loss order, an investor sets a predetermined price, known as the stop price or stop-loss level, at which they are willing to sell their investment if the market price reaches or falls below that level. This helps protect against further losses if the price continues to decline. Here's how a stop-loss order works. Setting the stop price. The investor determines the price at which they want the stop-loss order to be triggered. This price is usually below the current market price for a long position, buy order, or above the current market price for a short position, sell order. Placing the order, the investor submits the stop-loss order to their broker or enters it through an online trading platform. The order specifies the stop price and the quantity of shares or contracts to be sold or bought. Monitoring the market. Once the stop-loss order is in place, the investor should monitor the market to see if the stop price is reached or breached. Execution of the order. If the market price reaches or falls below the stop price, the stop-loss order is triggered and automatically converts into a market order. The broker will then attempt to execute the order at the best available price. The use of stop-loss orders can be an essential risk management tool for investors. It helps to protect against substantial losses during volatile market conditions or unexpected price movements. By defining a predetermined exit point, investors can limit their downside risk and protect their capital. It's important to note that stop-loss orders do not guarantee execution at the desired price. In fast-moving markets or during periods of extreme volatility, the execution price may deviate from the specified stop price. This is known as slippage. Additionally, stop-loss orders can also be subject to other risks, such as gaps in the market where the price bypasses the stop price, resulting in a worse execution price than anticipated. Therefore, while stop-loss orders can be an effective risk management tool, they should be used in conjunction with other risk mitigation strategies, such as diversification, thorough research, and ongoing monitoring of investments. Stop-loss orders are one type of order used in trading and investing. Here are some other order types commonly used in the financial markets. Market order. A market order is an order to buy or sell a security at the best available price in the market. When a market order is placed, it is executed immediately at the prevailing market price. Market orders prioritize speed of execution over price, so the actual execution price may differ from the expected price. Limit order. A limit order is an order to buy or sell a security at a specific price or better. If you place a buy limit order, it will only be executed at or below the specified price. If you place a sell limit order, it will only be executed at or above the specified price. Limit orders provide more control over the execution price but may not be filled if the market price does not reach the specified limit price. Stop order. A stop order, also known as a stop market order, is similar to a stop-loss order in that it becomes a market order when a specified price level is reached. However, the key difference is that a stop order is used to enter a new position or to exit an existing position when the price surpasses a certain level. For example, a buy-stop order is placed above the current market price and is triggered and the price rises to or above the specified stop price. Trailing stop order. A trailing stop order is a dynamic stop-loss order that adjusts as the market price moves in favor of the position. It is set as a percentage or a fixed amount below the highest price, for a long position, or above the lowest price, for a short position, reached since the order was placed. The trailing stop price follows the market price at a set distance, protecting profits if the price reverses but allowing for potential gains if the price continues to move favorably. Stop limit order. A stop limit order combines elements of a stop order and a limit order. It involves setting both a stop price and a limit price. When the stop price is reached, the order becomes a limit order, and it is only executed at the specified limit price or better. This order type provides control over the execution price but does not guarantee that the order will be filled. It's important to familiarize yourself with the specific order types supported by your broker or trading platform, as their functionalities and names may vary slightly. Understanding the differences between these order types can help you effectively manage your trades and mitigate risks according to your investment strategy. 1.2 Order placement and execution. Stop-loss orders are placed and executed in the market through a process involving the investor, their broker, and the trading platform or exchange. Here is an overview of how stop-loss orders are typically placed and executed. Placing a stop-loss order. Investor determines the stop price. The investor decides on the stop price, which is the price at which they want the stop-loss order to be triggered. This price is typically set below the current market price for a long position, buy order, or above the current market price for a short position, sell order. Order placement. The investor communicates their stop-loss order to their broker. This can be done through various means, such as an online trading platform, phone call, or electronic order entry system. The order specifies the stop price and the quantity of shares or contracts to be sold or bought. Transmission to the market. Broker submits the order. The broker receives the stop-loss order from the investor and transmits it to the market. The order is sent to the relevant exchange or trading venue where the security is traded. Order matching. The stop-loss order is stored in the market's order book, waiting for the market price to reach or breach the specified stop price, triggering an execution of the order. Price reaches or breaches the stop price. When the market price of the security reaches or falls below the stop price for a long position or reaches or rises above the stop price for a short position, the stop-loss order is triggered. Conversion to a market order. Once the stop-loss order is triggered, it is converted into a market order. This means that the order is now set to be executed at the best available price in the market. Order execution. The broker attempts to execute the market order by matching it with available buyers, for sell orders, or sellers, for buy orders, at the prevailing market price. The execution may be immediate, or it may take some time depending on the liquidity and trading activity of the security. Filled or partially filled order. The stop-loss order is either fully executed, partially executed, if there is not enough liquidity to fill the entire order, or, in some cases, not executed at all if there is insufficient liquidity or the market price gaps beyond the specified stop price. It's important to note that stop-loss orders are not guaranteed to be executed at the exact stop price. Market conditions, volatility, and order flow can cause slippage, where the execution price deviates from the specified stop price. Slippage can result in a worse execution price than expected, especially during fast-moving or illiquid market conditions. It's recommended to review and understand the specific order execution rules and policies of your broker or trading platform, as they may have specific procedures or limitations for placing and executing stop-loss orders. The interaction between stop-loss orders and market prices is crucial to understanding how stop-loss orders are executed and their impact on trading and investing. Here are the key aspects to consider. Triggering a stop-loss order. A stop-loss order is triggered and the market price of a security reaches or falls below the specified stop price for a long position or reaches or rises above the stop price for a short position. Once the stop price is breached, the stop-loss order is converted into a market order, which is then executed at the best available price in the market. Market volatility and slippage. During periods of high volatility or when there is a sudden gap in prices, the execution price of a stop-loss order may deviate from the specified stop price. This is known as slippage. Slippage occurs because the market order, triggered by the stop-loss order, is executed at the prevailing market price, which may be different from the stop price due to rapid price changes or limited liquidity. Order execution and liquidity. The execution of a stop-loss order depends on the availability of buyers, for sell orders, or sellers, for buy orders, in the market. If there is sufficient liquidity, the order may be executed immediately at or near the stop price. However, if there is low liquidity, the order may be partially filled or not filled at all. Market gaps and price spikes. Stop-loss orders may be vulnerable to market gaps, which occur when there is a significant price jump without any trades occurring between the previous price and the new price. In such cases, the market price can bypass the stop price, resulting in a potential execution price far away from the expected stop price. This is particularly relevant during periods of market opening or after major news announcements. Impact on market dynamics. The collective presence of stop-loss orders in the market can influence price movements. For example, A large number of stop-loss orders placed at the same price level can create a concentration of sell orders if triggered, potentially accelerating a downward price movement. This phenomenon is sometimes referred to as a stop-loss cascade or stop-loss hunting. It's important to be aware of the potential risks and limitations associated with stop-loss orders. While they are valuable risk management tools, there are no guarantees of execution at the specified stop price, and market conditions can impact their effectiveness. Traders and investors should consider these factors and incorporate them into their risk management strategies. Regular monitoring and adjustment of stop-loss orders may be necessary to adapt to changing market conditions and price movements. 1.3 Risk management and capital preservation. Stop-loss orders play a vital role in managing risk and protecting capital for traders and investors. Here's how stop-loss orders help in risk management and capital protection. Limiting potential losses. Stop-loss orders act as a predetermined exit strategy. By setting a stop price below the current market price for long positions, or above for short positions, investors define the maximum amount they are willing to lose on a trade. If the market price reaches or falls below the stop price, the stop-loss order is triggered, allowing for a timely exit and limiting further losses. Emotional discipline. Implementing a stop-loss order helps remove emotional biases from trading decisions. Fear and greed can influence an investor's judgment, leading to irrational trading behaviors. By setting a stop price in advance, traders have a systematic approach to managing risk. Reducing the likelihood of impulsive decisions based on emotions. Protection against unexpected market events. Stop-loss orders act as a safeguard in volatile or unpredictable market conditions. Sudden price fluctuations or adverse news can have a significant impact on investments. With a stop-loss order in place, investors are protected from large losses that can occur rapidly during such events. Preservation of capital. Capital preservation is a fundamental aspect of risk management. By using stop-loss orders, investors aim to protect their initial investment. Preserving capital allows for future trading opportunities and reduces the need for significant recovery from substantial losses. Flexibility and peace of mind. Stop-loss orders provide traders with the flexibility to set their risk tolerance according to their investment strategy. Different stop levels can be used depending on the security's volatility, time horizon, or personal risk appetite. Once a stop-loss order is in place, investors can have peace of mind knowing that their downside risk is limited, allowing them to focus on other aspects of their trading or investment strategy. It's important to note that stop-loss orders are not foolproof and have some limitations. During periods of extreme volatility or gaps in the market, the execution price may deviate from the specified stop price, resulting in slippage. Additionally, market conditions can change rapidly, making it necessary to regularly reassess and adjust stop-loss levels as needed. In conclusion, stop-loss orders are a valuable risk management tool that helps traders and investors protect their capital, limit losses, and maintain discipline in their trading approach. By defining an exit point in advance, investors can mitigate risks and make informed decisions based on their predetermined risk tolerance. Setting appropriate stop-loss levels is crucial for effective risk management and trading success. Here's why it's important to establish stop-loss levels that align with your trading strategy and risk tolerance. Risk control. Setting an appropriate stop-loss level allows you to control the amount of risk you are willing to take on a trade. It helps you define your maximum acceptable loss in advance, ensuring that you exit the position if the price moves against you beyond a certain point. By managing risk through stop-loss levels, you can avoid excessive losses that can significantly impact your trading capital. Account preservation. Establishing appropriate stop-loss levels helps preserve your trading account. It prevents a single trade from causing significant damage to your capital, allowing you to participate in future trading opportunities. Consistently preserving your trading account over the long term is crucial for sustainable trading success. Strategy alignment. Stop-loss levels should be aligned with your trading strategy and time horizon. Different trading strategies have varying levels of risk tolerance, and stop-loss levels should reflect that. For example, a day trader who seeks quick profits may set tighter stop-loss levels compared to a swing trader who aims for larger price movements over several days or weeks. Aligning stop-loss levels with your strategy helps maintain consistency and discipline in your trading approach. Volatility consideration. stop-loss levels should take into account the volatility of the traded instrument. More volatile securities may require wider stop-loss levels to account for price fluctuations, while less volatile ones may have narrower stop-loss levels. Adapting your stop-loss levels to the market conditions and the specific characteristics of the security being traded helps ensure they are appropriate for the price movements typically experienced. Technical and fundamental analysis. Stop-loss levels can be established based on technical analysis indicators, support and resistance levels, or key price levels identified through chart patterns. Similarly, fundamental analysis can provide insights into potential events or catalysts that may trigger price movements, allowing you to set appropriate stop-loss levels to protect against adverse market reactions. Regular review and adjustment. Stop-loss levels should be regularly reviewed and adjusted as market conditions change. Price volatility, news events, or shifts in the overall market sentiment can impact the effectiveness of existing stop-loss levels. By continuously monitoring the market and reassessing your stop-loss levels, you can ensure they remain appropriate and reflective of the current market dynamics. Setting appropriate stop-loss levels is a balancing act that considers your risk tolerance, trading strategy, market conditions, and analysis techniques. It requires careful consideration and ongoing evaluation to ensure that your stop-loss levels effectively manage risk while allowing for potential profits. Part 2, Advantages and Considerations. 2.1 Loss Mitigation. Stop-loss orders are a powerful tool for limiting potential losses in trading and investing. Here are key points highlighting their ability to serve this purpose. Predetermined exit point. Stop-loss orders allow traders and investors to establish a predetermined exit point for their positions. By setting a stop price, which is the price at which the stop-loss order will be triggered, they define the maximum amount they are willing to lose on a trade. This ensures that if the price reaches or falls below the stop price, the position is automatically sold, for long positions, or bought, for short positions, limiting potential losses. Risk management. Stop-loss orders are an integral part of effective risk management strategies. They help traders control and manage their risk exposure by placing a limit on potential losses. By implementing stop-loss orders, traders establish a clear risk-reward ratio for each trade, which helps them make informed decisions and avoid catastrophic losses. Emotional discipline. Stop-loss orders also promote emotional discipline in trading. Emotions such as fear and greed can cloud judgment and lead to irrational decisions. By having a predetermined stop-loss level in place, traders can remove the emotional aspect from their decision-making process. This helps them stick to their trading plan and avoid making impulsive and potentially detrimental moves in response to market fluctuations. Capital preservation. One of the primary objectives of using stop-loss orders is to protect capital. By limiting potential losses, stop-loss orders help preserve trading capital, ensuring that a single trade does not significantly deplete the overall portfolio. Capital preservation is crucial for long-term trading success, as it allows traders to continue participating in future opportunities without the need for substantial recovery. Flexibility and adaptability. Stop-loss orders offer flexibility and adaptability to changing market conditions. Traders can adjust their stop-loss levels based on market volatility, support and resistance levels, or changes in their trading strategy. This allows them to accommodate varying market environments and adjust their risk exposure accordingly. Peace of mind. Implementing stop-loss orders provides peace of mind to traders and investors. It relieves them of the constant monitoring and decision-making process, as the stop-loss order will automatically execute if the specified stop price is reached. This reduces stress and allows traders to focus on other aspects of their trading strategy, knowing that their potential losses are limited and well managed. Overall, stop-loss orders are a critical risk management tool that limits potential losses in trading and investing. By setting predetermined exit points and adhering to them, traders can effectively protect their capital, maintain emotional discipline, and participate in the markets with a well-defined risk management strategy. Stop-loss orders can be considered as an insurance policy against adverse price movements in trading and investing. Here's how they function in a similar manner. Protection against downside risk. Just as insurance protects against unexpected events, stop-loss orders protect traders and investors against adverse price movements. By setting a stop price below the current market price for long positions, or above for short positions, stop-loss orders serve as a safety net that limits potential losses. If the market price reaches or falls below the stop price, the order is triggered, enabling a timely exit and mitigating further downside risk, limiting exposure to market volatility. Market volatility can result in sudden and significant price swings, posing risks to traders and investors. Stop-loss orders provide a mechanism to limit exposure to such volatility. By establishing a predetermined exit point, traders ensure that their positions are automatically liquidated if the price moves unfavorably. This helps protect against adverse price fluctuations during volatile market conditions. Risk transfer, similar to insurance policies that transfer risk from individuals to insurance companies, stop-loss orders transfer the risk of adverse price movements from traders to the market. Traders delegate the responsibility of monitoring and executing the exit to the stop-loss order, reducing their exposure to potential losses. This risk transfer aspect allows traders to focus on other aspects of their trading strategy while having a safety mechanism in place. Peace of mind. Just as insurance provides peace of mind by mitigating financial risks, stop-loss orders offer traders a sense of security. By implementing stop-loss orders, traders gain confidence knowing that their potential losses are limited and well-defined. This peace of mind allows them to approach trading with a more disciplined and rational mindset, free from excessive worry about adverse price movements. Capital preservation. Stop-loss orders serve as a means of capital preservation, protecting trading and investment accounts from substantial losses. By preventing a single trade from inflicting significant damage to the overall portfolio, stop-loss orders help traders preserve their capital and maintain a stable financial position. This preservation of capital ensures that traders have the resources to participate in future trading opportunities. It's important to note that stop-loss orders, like insurance, have associated costs and limitations. Setting stop-loss levels too close to the market price may result in premature exits due to normal price fluctuations, while setting them too wide may increase the risk of larger losses. Traders need to find the right balance by considering factors such as volatility, time horizon, and risk tolerance. Overall, stop-loss orders act as an insurance policy against adverse price movements, providing protection, limiting exposure to market volatility, preserving capital, and offering peace of mind to traders and investors. By implementing these orders, market participants can effectively manage risk and navigate the uncertainties of the financial markets. 2.2 Emotional discipline and objectivity. Stop-loss orders play a crucial role in helping traders maintain emotional discipline and avoid impulsive decisions. Here's how they contribute to emotional control. Objective decision-making. Emotions, such as fear and greed, can cloud judgment and lead to impulsive decisions in trading. By implementing stop-loss orders, traders set predetermined exit points based on their risk tolerance and trading strategy. This objective approach removes the need for subjective decision-making during times of market volatility or when faced with unexpected price movements. Traders can rely on the pre-established stop-loss levels to make rational decisions, reducing the influence of emotions. Elimination of emotional bias. Emotions can cause traders to hold on to losing positions for too long, hoping for a reversal, or to exit winning trades prematurely, fearing a potential reversal. Stop-loss orders provide a clear and systematic approach to managing risk. Traders know that if the price reaches or falls below the specified stop price, they will exit the position. This removes the emotional bias that often leads to irrational decisions, allowing traders to stick to their trading plan and avoid impulsive actions driven by emotions. Reduce stress and anxiety. Trading can be stressful, particularly when faced with market volatility or unexpected price movements. The uncertainty of not knowing when to exit a trade can create anxiety. Stop-loss orders alleviate this stress by providing a defined exit strategy. Traders can place their stop-loss orders and have confidence that their downside risk is limited. This reduces anxiety and allows traders to focus on other aspects of their trading strategy, without constantly monitoring the market for exit signals. Protection against emotional roller coasters. Price fluctuations and market noise can trigger emotional roller coasters for traders. Without a clear risk management strategy, they may succumb to impulsive decisions driven by short-term market movements. Stop-loss orders act as a buffer, protecting traders from these emotional swings. They provide a predetermined level of protection against adverse price movements, allowing traders to stay focused on their long-term trading goals, consistency and discipline. Implementing stop-loss orders encourages consistency and discipline in trading. Traders who follow a systematic approach, setting and adhering to their stop-loss levels, are more likely to maintain a disciplined trading strategy. It helps them stick to their risk management rules and avoid deviating from their plan due to emotional impulses. By incorporating stop-loss orders into their trading strategy, traders can detach themselves from emotional decision-making, reduce stress and anxiety, and maintain a disciplined approach. These orders provide a structured framework for managing risk and exiting trades, allowing traders to make rational decisions based on predefined parameters rather than being swayed by short-term emotions. Objective rules play a crucial role in setting stop-loss levels effectively. Here's how objective rules contribute to the establishment of appropriate stop-loss levels. Risk management. Objective rules help traders manage their risk effectively. By setting stop-loss levels based on predetermined parameters, such as a percentage of the entry price or a specific technical indicator, traders can ensure that their risk exposure is consistent and aligned with their risk tolerance. This helps in maintaining a balanced risk-reward ratio and prevents excessive losses. Consistency and discipline. Objective rules provide a consistent framework for setting stop-loss levels across different trades. Traders can establish rules based on their trading strategy, market conditions, or technical analysis methods. Following these rules consistently helps maintain discipline in trading and avoids impulsive decision-making. It ensures that stop-loss levels are set objectively and not influenced by emotions or short-term market fluctuations. Elimination of subjectivity. Objective rules remove subjective biases and emotions from the decision-making process. Instead of relying on personal judgment, traders can rely on predefined rules to determine their stop-loss levels. This helps in avoiding discretionary decisions that can be influenced by fear, greed, or other emotional factors. Objective rules provide a systematic and logical approach to setting stop-loss levels, enhancing the overall trading process. Backtesting and optimization. Objective rules can be backtested and optimized using historical data. Traders can evaluate the performance of different stop-loss levels based on their rules and analyze how they would have performed in various market scenarios. This allows traders to refine and fine-tune their stop-loss rules, optimizing them for better risk management and improved trading outcomes. Adaptability to market conditions. Objective rules can be designed to adapt to changing market conditions. Traders can establish rules that consider factors such as market volatility, support and resistance levels, or specific technical indicators. This adaptability ensures that stop-loss levels are adjusted in response to market dynamics, keeping them relevant and effective in different market environments. Risk-reward assessment. Objective rules help traders assess the risk-reward profile of their trades. By defining stop-loss levels objectively, traders can determine the potential loss they are willing to accept in relation to the potential profit. This risk-reward assessment allows traders to make informed decisions about whether a trade is worth pursuing and helps them allocate their capital efficiently. Overall, objective rules provide structure, consistency, and logic to the process of setting stop-loss levels. They remove subjective biases, enhance risk management, and contribute to disciplined trading. Traders who establish and follow objective rules for setting stop-loss levels are more likely to make rational decisions and achieve consistent results in their trading activities. 2.3 Potential for improved risk-reward ratio. Stop-loss orders can play a crucial role in enhancing the risk-reward profile of trades by providing a predefined exit point to limit potential losses. Here's how stop-loss orders contribute to improving the risk-reward profile. Defining risk. Stop-loss orders allow traders to determine the maximum amount they are willing to risk on a trade. By setting a stop-loss level, traders establish a clear point at which they will exit the trade if the market moves against them. This helps control and limit potential losses, ensuring that they do not exceed a predetermined threshold. Defining risk in this way helps traders manage their capital more effectively and avoid catastrophic losses. Protecting capital. Stop-loss orders act as a safety net to protect capital. By exiting a trade when the price reaches the stop-loss level, traders prevent further losses and preserve their trading capital. This protection is essential for maintaining a sustainable trading account and avoiding significant drawdowns. By safeguarding capital, traders can continue to participate in other trading opportunities and maintain a balanced risk portfolio, optimizing risk-reward ratio. Stop-loss orders allow traders to set their risk level relative to their potential reward. By choosing an appropriate stop-loss level based on market analysis, traders can aim for favorable risk-reward ratios. A smaller stop-loss level compared to the potential profit target results in a more favorable risk-reward ratio. This means that even if not all trades are winners, a few successful trades can outweigh the losses, leading to overall profitability, allowing for effective trade management. Stop-loss orders provide a structured approach to trade management. Traders can use them in combination with profit targets or trailing stops to actively manage trades as they progress. By adjusting the stop-loss level as the trade moves in their favor, traders can lock in profits or reduce the risk exposure. This dynamic trade management allows traders to participate in potential upside while actively managing downside risk. Psychological benefits. Stop-loss orders can help traders maintain emotional discipline and avoid impulsive decisions. Knowing that there is a predefined exit point if the trade goes against them can alleviate stress and reduce the emotional burden of trading. It allows traders to stick to their trading plan and avoid making impulsive decisions based on fear or greed. This disciplined approach can lead to more consistent trading results and better risk management overall. It's important to note that while stop-loss orders can enhance the risk-reward profile of trades, they should be used in conjunction with other risk management techniques and tailored to individual trading strategies. Traders should carefully consider the market conditions, volatility, and other factors that may impact the effectiveness of stop-loss orders in achieving their risk and reward objectives. The impact of different stop-loss levels on overall trade profitability depends on various factors, including market conditions, trading strategy, and risk tolerance. Let's explore the potential outcomes associated with different stop-loss levels. Tight stop-loss levels. Placing a tight stop-loss level means setting it relatively close to the entry point. This approach aims to limit potential losses but may result in a higher likelihood of being stopped out by normal price fluctuations or market noise. While tight stop-loss levels can help protect capital and limit individual trade losses, they may also increase the frequency of stop-outs. This can impact the overall trade profitability, especially if the market subsequently moves in the anticipated direction. Wide stop-loss levels. Setting wider stop-loss levels allows for more room for price fluctuations before being stopped out. This approach provides a larger tolerance for normal market volatility and reduces the likelihood of being stopped out prematurely. However, wider stop-loss levels may result in larger potential losses if the trade goes against the trader. It's important to consider the potential risk-reward ratio when using wider stop-loss levels to ensure that potential profits justify the potential losses. Volatility-based stop-loss levels. Some traders employ volatility-based stop-loss levels that take into account the inherent volatility of the market or the specific instrument being traded. This approach adjusts the stop-loss level based on market conditions to reflect the expected price range. During periods of higher volatility, wider stop-loss levels may be used to account for larger price swings, while tighter stop-loss levels may be sufficient during periods of lower volatility. By aligning stop-loss levels with market conditions, traders aim to optimize risk management and potentially enhance trade profitability. Trailing stop-loss levels. Trailing stop-loss orders are adjusted as the trade moves in the trader's favor. This approach allows traders to lock in profits while still giving the trade room to capture potential further upside. By trailing the stop-loss level at a specified distance from the highest price reached since the trade was initiated, traders can protect profits and potentially exit the trade at a favorable level. Trailing stop-loss levels provide the opportunity to participate in extended price moves, potentially increasing overall trade profitability. It's important to note that there is no one-size-fits-all approach to setting stop-loss levels, and the optimal level will depend on individual trading strategies, risk tolerance, and market conditions. Traders should consider conducting thorough analysis, including technical analysis, assessing support and resistance levels, and considering market volatility, to determine appropriate stop-loss levels for each trade. Additionally, Traders should regularly evaluate and adjust stop-loss levels based on evolving market conditions to ensure they align with the risk-reward objectives of their trading strategy.